When's the last time you gave your 401k a tune-up? Actually, don't answer that. Since you clicked on this video, let's make 2023 the year that you give your 401k some fresh TLC. My name's Alex Rezzo. I'm a CFP, CFA, and CPA, but most importantly, I'm here. I've got expert tips to help you get more mileage out of your 401k. Let's get started. If you want to take a fresh look at your 401k this year, then you're in the right place, because this is the first video in a three-part series completely focused on optimizing the impact of your 401k account. To start this series, we'll dive into a problem that I'm seeing pop up more than ever: people leaving their 401k accounts behind with past employers. Since 2021 was the year of the Great Resignation, and 2022 was unfortunately just not so great of a year, many more of us than normal have a 401k account held with an old employer right now. And if that's not the case for you yet, I'd encourage you to keep watching because you'll want this info eventually. Unless your plan is to keep working for your current employer until you die. Literally. Now, there are many problems with leaving a 401k with an old employer, but I'll highlight just one here: plan administrative expenses. All 401k plans have administrative expenses to meet the rigorous legal and accounting requirements of maintaining those plans. Thankfully, most employers will pay those fees for the plan instead of charging them through to their employees. They're motivated to do this because they want to keep their employees happy. It makes them look kind of cheap if they don't. What employers are not motivated to do is cover administrative expenses of previous employees. That's why a company will often notify you that you'll start receiving new charges for those administrative fees upon your exit from the company, if you read the fine print of your separation agreement. If you don't catch that in the fine print, you may end up unknowingly paying hundreds of dollars to help your old employer cover its plan expenses. The easiest way to ensure that doesn't happen to you is by transferring any and all of your old 401k accounts into either one, an IRA, or two, another qualified plan, like a 401k plan with your current employer. So, which of those two options should you choose? Well, each option actually has some significant pros and cons, so let's walk through some of the factors to consider if you want to optimize that decision based on your situation. For transferring your old 401k to an IRA, the advantages generally include the following. 1. Greater flexibility with investment selection. 401ks often only offer a limited selection of investments to their account holders, whereas IRAs usually have access to a much wider universe of choices. And 2. One less transfer. Like I mentioned earlier, unless you're planning to work for your current employer until you die, transferring your old 401k to another 401k will just mean that you'll likely end up transferring that account again once you change jobs or retire. Your IRA is much more likely to be a long-term home for those assets. Conversely, a drawback of rolling an old 401k account into an IRA is that it may prevent you from using an advanced tax planning technique called the backdoor Roth. If you haven't heard of backdoor Roths, in short, they generally only help you once you're earning more than $129,000 a year as a single taxpayer or $204,000 a year as a married couple filing jointly. Once you hit those income levels, the tax code limits your ability to contribute money to a Roth IRA through the front door. Hence, backdoor Roths are a thing. Switching gears to the other potential landing spot for your old 401k, here are some pros and cons of using your current employer's 401k plan for that. Advantage 1 is better protection from creditors. Whereas IRAs may be protected only up to $1 million in a bankruptcy, depending on which state you live in, 401ks generally have broader protection against creditors. The second advantage of using your new employer's 401k plan is that it may offer better flexibility if you retire early. Let's say you want to retire before age 60. Some 401k plans leverage an IRS provision called the Rule of 55, which means that you can take penalty-free distributions from a 401k at age 55 or older once you leave your job. In contrast, the Rule of 55 is never allowed for IRAs. You generally have to wait until age 59 and a half. Pivoting to 401k drawbacks, they generally are more complicated to navigate because they depend on how the plan sponsor designed them. Maybe your current employer's plan doesn't allow Rule 55 withdrawals, or maybe it won't even accept a rollover from your old 401k account. Or worse, maybe it will, but it's one of the minority of plans which charges administrative expenses to current employees. You can learn more about your plan's rules in a document called the Summary Plan Description, or SPD, but honestly, reading that will probably leave you with more questions than you started with. Once you've decided where the best home for your old 401k account is, congrats, you're half the way there. All that's left is requesting the transfer. Since I've seen some people get intimidated by this part of the process, here are some practical tips on how to proceed based on which option you choose. If you decide to transfer your funds to your current employer's 401k, you can start the process by reaching out to your HR or benefits contact at your new company and asking them to confirm if they will accept the transfer of your old 401k. If they will, you can ask them to help in making a direct transfer to your new plan instead of to you individually. And make sure to use that magic word direct. I'll explain why a little later. To be clear, if your current employer plan accepts old 401k transfers, there are people working for your company or its 401k plan whose full-time job it is to help you with this. So please, put them to work so you can waste as little of your time on this as possible. Alternatively, the process can look a bit different if you decide to transfer your old 401k funds to an IRA. As a quick note, technically, transferring a 401k to an IRA isn't called a transfer. It's called a rollover, whereas transferring a 401k to another 401k is called a transfer. But I don't think you really care, so in this video, I'm using the terms transfer and rollover interchangeably. Now, if you decide to transfer your funds to an IRA, the first thing you'll want to do is make sure that you have the appropriate IRA to receive the transfer of your old 401k account. Unless you want to deal with tax complexities, your simplest course of action is to make sure that your traditional 401k accounts transfer directly to a traditional IRA and any of your Roth 401k accounts transfer directly to a Roth IRA. If you don't have the type of IRA you need yet, no worries. Your preferred financial institution can help you set up a traditional IRA and or a Roth IRA either online or over the phone. And to be clear, even if you have just one traditional IRA and one Roth IRA, you'll be able to use those for receiving funds from multiple old 401ks. Once you've confirmed which IRA account you want to receive the 401k transfer, keep the account number handy and reach out to your previous employer's benefits department over the phone or through the online portal where they help you manage your old 401k. By the way, if you can't find your old 401k's plan's contact information or you can't remember your login credentials, make sure to stick around till the end of this video for a potential solution to that problem. When you make your transfer request, either on the phone or online, don't forget that magic word from earlier. You can ask for a direct rollover to your IRA account instead of to you individually. Now, I keep harping on that magic word direct because if your old 401k makes the transfer or rollover payable to you instead of payable directly to the custodian holding your new 401k or IRA, that transfer can be subject to a mandatory 20% tax withholding, which you want no part of. With that said, don't be too alarmed if your old 401k plan insists they have to send you the check for you to pass along to the new custodian. It's certainly annoying because most plans these days can make the transfer electronically to your new custodian, but some plans will mail a check to you for you to forward along. If this happens, just make sure that your old 401k provider makes the check payable to your new custodian instead of just you. For example, if you're directly rolling over your old 401k account into your IRA at, say, Charles Schwab, the check from your old 401k provider would look something like this. Pay to the order of Charles Schwab, FBO, for benefit of your name. If you receive a check like this, call your new custodian and ask them if you should add any memo items to this check that weren't originally printed on it, such as your IRA account number, before you send that check their way. And while you're at it, it's also worth asking whether you can send the check through mobile deposit instead of sending it through the mail. And as an FYI, as we finish up, I didn't originally plan for the video to be this long, so now even I have a new appreciation for how these little details can add up through explaining this financial chore. As a reward for your perseverance, I'll finish up the video with some good news that may make this process a lot easier. If you stick around for my closing thoughts, I'll tell you about a free service provider that may be able to help take this chore off your plate. As promised, I want to let you know about a company called Capitalize that specializes in helping you transfer your old 401ks into an IRA if that's what you decide to do. One caveat, as of the time I'm making this video, they can only help you transfer your old 401k accounts into IRAs, not other 401ks. Now, from what I understand, they'll manage the process end to end for you and even help you find old 401ks you forgot about. And the beauty is that's a free service to you because the financial firm that you choose to receive the old 401k pays Capitalize to win your business. Now, to be clear, I've never used Capitalize and I have no relationship with them. Since I'm a financial advisor, my firm Andante Financial directly helps our clients with chores like this. So while I can't recommend Capitalize per se, I will say it's worth checking out to see if it's a good fit for you, particularly if you have multiple old 401ks floating around. And if you've used Capitalize already or end up using it after watching this, can you do me a favor? Please leave a comment below to let other viewers know whether it was a good experience. And with that, you're done with the first video in this 3-part series to help you tune up your 401k in 2023. Next week, I'll post part 2, and don't worry, it has nothing to do with transfers, rollovers, or planned administrative expenses. Once that video's up, I'll link it right here, but if you're watching this video the first week it's out, here's a picture of my dog Daisy to tie you over in the meantime. Until then, thanks for watching.